Well, we're back with you, keeping a close eye on your ag commodity trade here on the final trading day of 2019. I'm Marlon Bowling with you, your tour guide to the ag commodities. And as we look at our grain trade right now, the corn market just has not ventured very far from unchanged. It seems to be on a short leash today. We currently have the March contract just down a half cent. Now we're at 387 3/4. The entire trading range, only about 3.5 cents from the overnight trade till now. The May contract down 3/4, and it's at 394.5. Now, if you look at the soybean trade, soybeans have been kind of choppy here today. We have January now at 938 3/4. About a couple of pennies off our earlier high of the day. We're now down 3/4 cents. So we've been on both sides of unchanged, but we are about a nickel off our earlier low. The wheat market in Chicago, currently on March, we're trading unchanged at 556. The deferred contract's fractionally higher, so not much going on there. Kansas City wheat today, kind of a similar story. We're only 3/4 higher now at 481 1/4. I should point out that backed off of its earlier high today by about 4 cents now. On the Minneapolis wheat, we're actually trading 2.5 higher at 559 1/2. We did have deliveries this morning, believe it or not. Yes, January deliveries, they came into effect here today, and they would impact the soy complex and the rice. So what we had was soy meal deliveries of 1,355 contracts, soy oil 1,003 contracts, rice 409, and the soybeans 795 contracts posted for delivery this morning in Chicago to kick off first notice day. To talk about it, let's bring in Brian Hoops of Midwest Marketing Solutions and get his thoughts on what's going on with this market action here. Deliveries seem to be a little bit of a disappointment to the trade here today. Don't you consider them to be relatively high, Brian?
Yeah, especially for the bean oil market, and that's one that we're seeing take the brunt of the selling pressure. It's also interesting that it's the end of the month, end of the quarter, and end of the year, and the bean oil has been the one that's been performing the best. So we are seeing some large-scale profit taking based off of traders wanting to kind of square up some of those positions ahead of the end of the year and the month and the quarter. And that's why we're seeing the biggest losses in bean oil. I think a combination of those two factors.
Why is that the case? Why have they been focusing on the oil side?
Well, the bean oil is the one that has been moving sharply higher, and it's mainly tied to Malaysian palm oil futures. That market has rallied to 5-year highs, not just contract highs. So that market has been pushing sharply higher, and with it has spilled over into U.S. soybean oil futures, and that has allowed that market to rally. And a good portion of this rally has been tied to soybean oil, but also soybeans getting a good bump here in the last 30 days or so because of the China trade agreement. So those are the markets that kind of are seeing some profit taking going into this end of the year type trade.
Now, the dollar has really been sagging here yesterday and today. Let's take a look at the dollar value right now. And on the U.S. dollar index, we've been watching that March futures contract over there. And right now, it's down roughly about 300 points at 96.140. And hold that thought. We'll pick up on that discussion when we come back after a break. That could have an impact on the grain and even the livestock trade. So we'll talk more with Brian Hoops about that when we come back. Brian Hoops rejoins us now as we take a look at our livestock trade. And while we had kind of a mixed affair going on here in the grain side, let's see what's going on with the livestock. We talked about the weaker dollar there a minute ago. About live cattle and feeder cattle and hogs, we have live cattle kind of coming under pressure now. We're almost on the low of the day. February down 58 at 125.85. That's only one tick off of its daily low here. April down 58 cents at 127.10. That's a nickel off of its daily low. On the feeder cattle market right now, you currently have the January contract trading 25 lower at 145.18, within a dime of its low of the day. March down 55 at 143.95. On the lean hog trade today, we'll start with that nearby February contract. It's down 58 now at 71.22, so about 60 cents, 65 cents off our earlier high this morning. April now down 42 at 78.20. So, Brian, definitely a lower tone, a weaker tone everywhere you look in the livestock trade. To what do you attribute all that weakness here today? Is this technically related, or what do you look at?
Yeah, it kind of goes back to that same thing we were talking about in the grain markets, with bean oil seeing the brunt of the selling pressure because it's a market that's fat with fund profits. The same thing in the cattle. They've had a huge rally. You go back to the lows that were made in September the 9th. February contract made a low that day of 105. Now we're up to over 125, almost 126. So there's a large profit sector here that's wanting to bank a little bit of money ahead of the end of the quarter and end of the year. And I think that's what we're seeing in the cattle market. The show list numbers this week are a little bit negative. They are about 7,600 head larger than a week ago. So that could put a little pressure against the cash markets. But I think we'll see coming back after this new year begins in Thursday, Friday, we may see some buying interest come into the cattle market once again, trying to anticipate where this week's cash rate is going to shake out.
We have some updated information on the pork packer margins as they are calculated by the Wall Street Journal using information from Iowa State University and other sources. Let's take a look at what it showed as of December 30th, yesterday. The margins calculated out to be 46.44 compared to 49.06 the day before. And you go back to December 26th, they were over $51 at that time. So the margins are declining there. Is that much of a concern for you to hold up the market here?
Well, they've been in a steady decline. You remember back in late September, October, when we just started to increase the kills, the profit margins at that time, it ballooned to over $400 a head, and they've slowly been weakening as cutout values have been dropping and the packers have been paid higher for the cash markets. That's cut into their margins. So at some point, we think it'll stabilize in here, and the cutout values will start to improve a little bit. That also may affect the cash markets from being such a bullish market that we've seen over the last 3 to 4 months. We may start to see more of a stabilization, but I think as long as we stay profitable, we're going to stay at least steady to higher in the cash trade.
All right, Brian, best wishes for a Happy New Year in 2020. Brian Hoops of Midwest Market Solutions. He is based in Springfield, Missouri. So, John, back to you.
Gentlemen, thank you very much. Appreciate it.